Hello and welcome back to Starting Your Investment Journey audio series. Now, up to this point, what we've done is to build a journey, right? And if you are joining us in this place, please ensure that you go to the beginning and listen to all of them. In the last episode, we're talking about inflation. So now let's get to another one that can help you to understand how investment works in uncertainty, and that is called risk. Now, when most people hear the word risk, they immediately think of danger or loss or something bad. But in investing, risk is not just like that. Thinking about it as something bad is not the full picture. Now, risk simply means the uncertainty of outcomes. It is not good, it is not bad, it is just uncertain. So whenever you invest money, you are never dealing with certainty. You are dealing with a strange possible of outcomes, right? So something can be better than expected, or it can be worse than expected. That gap between the actual and the predicted is the risk. Now, note this. The risk itself does not mean loss, right? So risk exists even when you make money, as long as there's a difference between the expected and the actual, whether in the positive sense or in the negative sense. That is risk. So as long as the outcome is not guaranteed, there is a risk. Now, let's take an example. Let's say you invest in a business or a stock. You expect a 15% return, right? But the outcome could be, let's say 5, let's say 15, or 30%. Or it could even be a loss. That variation, that difference between the expected and the actual is a risk. Now, there are 3 types of risk that I think you need to really pay attention to. Number 1 is volatility risk. Volatility risk is not a big word. It's not a big word. What it just means is that prices move up and down. That is what volatility is. It is not fixed. It is changing. So even the strongest investment can move sharply in the long term, either move sharply up or move sharply down. And that movement can create emotional pressure. So people may feel like, this thing is going down too fast. Should I sell it and stop loss? Or if this thing is moving up very fast, I'm not sure it's not going to reverse. Let me quickly sell it and take my profit. So that volatility is a risk because you are not sure whether you should sell or you should buy or should remain in the market. That's a risk. Volatility risk. The second risk is liquidity risk. Now, liquidity is how easily you can convert your investment into cash, right? That is what liquidity is. Now, some assets are easily liquidable, right? Or they are easily liquid. So you can easily set them quickly. And others may take time or force you to accept a lower price. Example of asset that you can't easily sell fast is real estate. If you need to sell it very fast, you may have to accept a lower price than the market price. The third type of risk is called systemic risk. Now, this is a risk that affects the entire system. Now, for this one, you are not directly responsible for it. Example is economic downturns or currency instability or financial crisis. Now, when this happens, many assets are affected at once. So it is not directly what you can control. So here is an important distinction to note. Now, many confuse volatility with loss. The fact that something is volatile does not mean that you are losing, because volatility is just movement. That a market drops sharply doesn't mean that you have lost money. You lose money when you make a decision, for example, to sell under panic. What if the market goes back up and it enters back into profit? So the fact that the market is volatile does not mean that you've lost. You lose money when you make a decision. Or let's say a market moves up very sharply and you decide to buy. Because of that, you feel like, this market the price is going up, so let me quickly buy so that if it goes further, I can also make profit. What if the uptrend reverses and people begin to lose money? So that's what happens. So loss happens when people make decisions based on that kind of movement, that volatile movement. So most people actually lose money, not because the investment was bad, but because their reaction to risk was wrong. And usually what do? They'll panic, they'll sell too early, and they'll chase a safer options at the wrong time. So that is what That is what they do, but that is not right. Now, we need to understand that risk cannot be eliminated completely in investing. You can't completely eliminate risk. What you can do is to manage risk. What you can do is to take calculated risk. Because even the investment decision that you are taking, you are making a trade-off between risk, return, and time. If there is no risk, there's actually no meaningful return. So low risk often means low growth in most times. And high growth often comes with uncertainty. So that's why the goal is not to avoid risk. The goal is to understand it clearly enough to make rational decisions under it. So once you understand risk properly, you stop panicking during market movements. You stop chasing safe but ineffective returns. You start thinking in long-term probability, not short-term emotions. Now, all right, that's a very good one. Now that we've understood two powerful forces in the market, right, inflation and risk, now let's introduce the human factor. And human factor is that even though you have knowledge, you are still an emotional person. So even with the perfect knowledge of markets, most investment mistakes are still emotional mistakes. So thank you very much and see you in the next episode. Remember, always go for knowledge before you buy. Don't put your money in what you don't understand. Always understand what you are putting your money in and always think in long term. Thank you very much and see you in the next episode.